Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Jeffrey Phillips of Global Market Development.
And before that, Corey and I will talk about the huge blowout employment numbers and what that implies for interest rates ahead.
And remember, if you want to get in touch with us, send us an email to feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. Well, it ain't looking like a recession anymore, I'll tell you that, because employment numbers were just blowout. They were expecting 190,000 jobs, and the U.S. added 339,000 jobs in May. It's just not feeling very recession-y to me.
Doesn't sound like it based on that number, right?
Yeah, I mean, David Cervantes, who we had on the show, he said, the economy is en fuego. It's on fire. We're just cranking along here. But, like I said in the intro, this has implications, of course, for Fed policy, which the entire world is focused on because, fastest tightening cycle in history. What are they going to do next? Higher for longer would be much worse than I think what the market and everybody's expecting. And yet we get these en fuego numbers and, the market is discounting a pause or a skip in June this month. I don't know. Maybe they do skip, but who cares, right? They're gonna hike again, period, right?
You have to think eventually, yes, they will, even if they take the new skip over the next month, this month when they meet again. You're not seeing the employment situation or the jobs market weaken significantly beyond what has already happened. Really, we're talking the end of last year was when we were talking about all of the kind of the layoffs in tech and that sort of thing. I think that part happened, which kind of led the bubble in, with all the overgrowth of some of these companies and the fears of what were going to come and or the reality led to job cuts in the tech world. But yeah, when we're seeing double the expected job creation at this point, I don't think this was what the Fed was going for or was expecting at the beginning of all of this. So, that the jobs part is important because they're balancing basically inflation in the jobs market and don't want to see the runaway part of inflation with wages, getting permanently in a unsustainable.
Well, yeah, I mean, it's the other part of their twin mandate, right? Stable pricing, meaning stable inflation, and maximum possible employment. And unemployment is still under 4%, which is pretty low. And now we're adding all these jobs. I don't know. I just still think that complacency is baked into the market. It has yet to fully top out. Now we have an AI bubble developing, with Nvidia priced like Cisco was priced in March of 2000. It's just like 200 times net income. It's the plumbing of this current mania. It's like the exact same situation. And Wall Street has it as a buy. All of Wall Street analysts have it as a buy at 200 times net income. And, there's I just still feel like there's more downside, even after a year like 2022. Nothing's cheap. I mean, what's cheap? I don't know. Not much.
Nvidia certainly isn't cheap. That makes me laugh too. Now it's a buy. Okay, what about 6 months ago when you actually could have made a decent gain on it? Yeah, but yeah, that's buzzy. Like I said last week, that the whole AI thing. I mean, anybody who's paid attention to the world and the markets has known AI has been a thing for 5 or 10 years. So for it to get mainstream now, yes, that does tell you something.
Yeah, did you see that on Twitter? A guy showed the cover of like Forbes magazine from 1998, and it was about this company that was beating Dell in some way. I forget what it was called, PCsomething.com, and or PC Order, or PC Order Now. I think it doesn't really matter because it's gone. You can't find it; doesn't exist anymore. But the cover of Forbes was like, PC Order Now is beating Dell using artificial intelligence, and they had a picture of the CEO. And people have been talking about artificial intelligence most of my life, and I'm 61. So, it's been around, but obviously, ChatGPT has kind of alerted the whole world that it's here and it's real. I mean, it's I think we're gonna see very interesting, like those obnoxious customer service lines are. Maybe they'll get a little less obnoxious and a little more, usable, and other things too. I mean, and one of the things, like I asked ChatGPT, what is so great about artificial intelligence or something like that, and it listed these things, and one of them was enhanced personalization, and the little blurb next to that was about ad targeting. Like, we haven't had that for 20 years. I mean, I can't open my computer without it trying to sell me a new gun or a knife or whatever I just bought 10 minutes ago. It's, so I don't know.
Right. Yeah. That's as with anything, there's a a bit overblown with if it's going to change. AI is and has been already changing certain things, but and it may change some jobs and sectors more than others. But I've seen, from so I'm not a talker by trade. I'm a writer by trade, right? And so a lot of people in the writing and editing industry are, basically, oh, this just replace our jobs, and but I don't, like, from writing perspective, I don't think it's going to replace anything original, right? Like, it doesn't replace the human being able to create anything original, and it can replace kind of like those menial articles, which you already see, like, in financial media, like AI has been writing earnings reports and news and stuff for years, and you'll see it, and as a discerning financial media consumer, you can kind of tell, like, all right, this is written by a robot and maybe looked over by somebody, and that's that. But that doesn't tell you much. I mean, it just basically compiles what you could read, and that's something that AI can do, right? Like, it can kind of cut some of the time out of things that routine things, sort of. But as far as like creating new originals things, I'm not that worried about it.
I'm not worried either. I asked it one time. I think we might have talked about this. I asked ChatGPT to, if it knew who Dan Ferris was, and it sort of knew who I was, and I said, "Can you write a stock recommendation in the style of Dan Ferris?" And it said, "Sure, I can do that." And the thing that it recommended was renewable energy. I'm like, boy, you couldn't have got it more wrong, Just,
there you go. You got that's your job security, right? Like, what are you talking about? AI.
Yep.
You got no
zero.
idea.
Yeah. But the one thing that, for example, Jensen Huang, the CEO of Nvidia, co-founder, CEO of Nvidia, he was saying at this event recently in Taiwan that I mean, as if there wasn't enough hype, he's saying, it's the tipping point of a new age of computing. And he said, basically, we're all programmers now, because all you have to do is talk to the AI platform and tell it what kind of code you want to write. And I've done that. I said, can you write me some code that does this or this or this? And man, it's done. Like, it's done instantly, and the code just goes zip right in front of your eyes. I'm like, wow, if I were a low-level programmer in a big company, I'd be very worried right now.
Yes, that's, but I'm sure one of the things I was thinking about when saying it'll affect certain jobs more than others, like coding. some people think, oh, we should learn coding right now, and yeah, that's a good skill to have. But at the same time, AI can do a lot of
Yeah.
that stuff. So yeah, that's
Maybe
one.
we should learn to tell the AI platform how to code, because that's a skill. That's,
Right. Well, another thing, I was, transition here. I was thinking, can we teach the AI to lower inflation? Can we or cut inflation? Or can we figure that one out? Because it's not going anywhere. And going back to the Fed and what this means for unemployment and interest rates, it doesn't seem like the likely scenario would be not or lower rates, right? Like that doesn't factor in anywhere right now, right? And so, I mean, maybe that's another reason why the Fed people out there talking were referring to this now as a skip, as we said, because that implies that the rates will go higher, not lower, even if they pause this month. I think they're just trying to see, like, I don't know exactly what, but I think they probably want to see what some of this fallout from the banking crisis is in terms of credit tightening and that sort of thing, and just not ruffle anything too much there, is my guess, this month. And then just, but if the inflation, like the PCE numbers, stay where they are, and they actually went up the last month, they didn't go down. This is the number, the inflation number that the Fed pays attention to. So you have, all right. So forget the past 18 months. You have inflation going slightly higher. You have jobs market at record lows and not showing significant signs of weakening. And you have a stock market drifting higher since October. Does that say lower inflation's coming? I no. So it's I'm the more I go through this and waiting, people are waiting for this recession to happen, waiting, and wondering what's going on and why isn't the bottom falling out yet. I mean, I'm just trying to forget like the past and just look at what's happening now. And if you look at it that way, you would think the Fed needs to raise rates higher eventually than they're saying. And it may not be next month, but at the very least, they're going to hold the rates where they are, and then eventually, maybe they'll raise more.
Yeah. So I'm looking at the Fed Watch tool right now, the June contract, which yeah, I think it actually expires at the end of June. Last time on the show, I think I said that the contracts expire on the meeting day. I think that's not true now, but obviously I don't trade them. Who cares? They're so weird. But so the June contract, which is really all about the June 14th meeting, on May the 10th, there was a 99.6% probability that rates would stay as they are. Now it's down. I guess it's down to about 80%, or below 80%. Before that, it was all over the place. It was like, 50, 60, 30. I mean, it's been everywhere. It's almost like, and if you look at the chart, it looks like a 2-year-old is scribbling with a crayon on the refrigerator. It just doesn't. It looks like a chaotic market. In other words, like nobody really has any idea now that they've hiked, 500 basis points just real quick. People are really uncertain about what comes next, which I think is, it's a short-term bet, so I get it, right? But overall, I think it's almost like a waste of energy to even think about it, because there's no way we're not higher for longer, whatever that might mean. If you think it's a big difference that it's, that the Fed funds target is 500 to 5.25 for the next 2 years versus 475 to 500 for the next 2 years. Like, I don't think, I think the focus is still way off. I think there's still too much like optimism out in the world. People are still like looking for bottoms and wanting to buy dips. There was some stuff recently, within the past month or so about like people are just still so into buying the dip. And I don't think that's going to work for the next 10 years. I think you're going to be disappointed on your dip buying, and I think growth traps. This is another thing. I think growth traps are 10 times worse than value traps now. And GMO put out some research recently showing that, that growth traps, you're just as likely to get into a growth trap as a value trap. 25% of the market is one or the other. And whether you're buying stocks in the cheapest half or the more expensive half, doesn't matter. 25% of the time, it's a trap, meaning the revenue is going to keep declining. The fundamentals are going to keep declining. So things get cheap and become value stocks because of that. So it's not as bad when you're in a value trap as in a growth trap when, whoa, the value, the revenue declines. And that of course, is what has happened to Nvidia. Trailing 12-month, the revenues declined last, 3 periods. And they're claiming that it's going to climb 50%, quarter over quarter next time. But, we'll see. And in the meantime, it is priced like a classic growth trap. And the value traps, they lose you money 15% a year. The growth traps lose you money 23% a year.
Right. Yeah. I hadn't seen that, but yeah, that describes what Nvidia, right? Growth trap. And that would be something, watch out for those going forward.
Yep. We never hear about these either. Like all the growth people like to say value investing doesn't work. You're half of them are value traps or whatever. Well, a quarter of them are, but yeah, guess what? A quarter of your picks are traps too.
Yeah,
and they're going to treat investors a lot worse.
I could think of a bunch of them right off the top of my head from 2020, 2021, right? Like remember all the work from home stocks, Zoom, Peloton. It's the same characteristics and signatures as Nvidia now. Although I will say Nvidia is probably a more robust company than in either of those.
Yeah, it's a much better business than those.
Similar Mr. Market behavior, I would say, around it though.
Yeah, it is. And it's it's got a Nifty 50 vibe to it where, Nifty 50 was back in the 50 big stocks back in the late 60s, early 70s that people said you could pay anything for them because they'll grow forever. And it was like Xerox and Polaroid. I mean, no kidding, and they were down 90% within a few years. And it's the same kind of vibe here because it's like, well, you can pay 200 times net income for this thing because it's going to, AI is going to take over the world. And it's just like the internet boom. The internet did kind of take over the world. It did transform the way we live and work. And you still got murdered in all the big stocks. You still got murdered in Cisco and Microsoft and all the rest of them, Amazon, whatever. So, and most of them, didn't turn out like Amazon, where you could have bought it at the top and still made, 1,000 times your money or whatever crazy thing it was. So, I don't know. I don't think you should count on Nvidia being the next Amazon where you can buy it at the top and hang on for 30 years and it'll be worth, $100 trillion. I mean, unless the currency goes Zimbabwe. I mean, I just don't see it.
Well, maybe unless the currency goes Zimbabwe, we might. Who knows? Maybe we're getting close. I will say that I don't want to not pay attention to what like the broader market is doing too, right? Like we're talking about these tech stocks, and they've gotten a lot of the headlines and have pushed the Nasdaq, which is mega cap tech stocks, up, right? Like I think it's like 25% since the start of the year. The rest of the market. Now you can look at this two ways. The rest of the market hasn't done great, right? Like, and you look at market breadth with that, which I like to look at. The number of stocks going up versus down. They're actually more. There's more going down over the last year than up. So you can look at that two ways. You could say, there's this tech frenzy again, or AI bubble that's pushed headlines higher, which is true. And then there's the other ones that are just kind of dragging along sideways, and which seems more appropriate for our times, which is fine. And the stuff that's probably not getting overvalued at this point. And then maybe it could be a bullish thing. We know there's a lot of cash on the sidelines. And if there's not, we're not seeing bubblicious stuff all over the market. I mean, it feels like it, but it's really not everywhere. I'm just pointing that out. Like, if you think October was a bottom, if you're a believer in that, and you're looking at this and you're saying, as we speak today, or hitting a slightly newer highs above February, since October. My point is, it's not the worst of stock markets we've ever seen either, as far as compared to last year.
Oh, true. I mean, yeah. And, it's funny you said, like, the rest of the market, except for the NASDAQ, it's like the whole rest of the NASDAQ, the indexes are being pulled up by 5 or 7 stocks, and the rest of them are kind of sucky, which is very interesting in and of itself. So, yeah, I mean, I think we're either going to see, a lower bottom at some point in the next year or 2 or 3 or however long it takes. I don't care. The timing doesn't mean anything to me. Or we've already started going sideways, and it's going to be a brutal chop for 10 years, like what followed all the other big mega bubbles that I've talked about and talked about and talked about until I'm blue in the face.
I'm increasingly believing that we're in the sideways market already, and so that's what that's my personal base case. That doesn't mean anything other than my view, but I mean, the more I think about it, and I forget that I've thought this before, like this all of the stimulus of 2020 and 2021, like, it's not just going to go away like poof overnight, and I'm saying the consequences of that, it's just not. And we could be in this inflationary era for a decade, and if that's the case, it's going to be a higher rate environment, a tougher growth environment, and make of that what you will. You call it whatever you want, but I think it's just more important to think about the broader conditions that we're in than labeling things recession, not recession. Yeah, I'm thinking Mr. Sideways as well for the time being.
All right. Well, now that we've successfully predicted the next 10 years of the future, we'll talk to somebody in the present, and that somebody is Jeff Phillips. He's a rich, successful investor who's been around for decades and decades, and I think you will all really, really enjoy what he has to say. Great guy, great talker, successful investor. Let's talk with him right now. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. And he just gave them a dire warning. Mark says we're about to witness a historic stock market shakeup that could soon create devastating losses for investors who don't know what's coming. As a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history, and he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. If you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at www.rollingcrash23.com. He includes the name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of beloved pet brand Chewy before it fell 45%, tech company C Limited before it fell 66%, furniture company Wayfair before it fell 76%, social media favorite Snap Inc. before it fell 36%, and food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the famous FANG stock fell 35%. So you'll want to avoid the stock in his new report immediately. Again, simply go to www.rollingcrash23.com for your free copy of this new report. All right, time once again for our interview. Today's guest is Jeff Phillips. Jeff Phillips is a self-styled speculator who's been around a while. He's had lots of success in a lot of risky markets, and we're going to talk with him today about whatever comes to mind, but we will focus on what Jeff does best. So with that, Jeff, thanks for being here.
Thanks for having me, Dan.
So Jeff, before we hit the record button here, you were telling me you don't call yourself an investor, you call yourself a speculator. And that's a really interesting distinction to me as a, somewhat of a devotee of the Ben Graham philosophy of value. He describes those two things as being very separate, and he describes them very, very particularly. But what I want to know from you is, why a speculator? Why do you not call yourself an investor?
Mainly because I've been in the natural resource sector, which I can explain a little bit more, for the last 30 years, which is investing. People call it investing. I call it speculating, organized, with some knowledge base. But there's so many risks in that market. Whether you're looking at different commodities from copper to zinc to oil and gas to gold, rare earths, lithium, critical metals. And there's so many different specialty areas in that segment. And, there's just a lot of risks. So you're really speculating. And that's what I've been doing for 30 years, unlike investing in dividend paying stocks and companies that have cash flow. You're speculating on finding something that's going to have value for someone later on that you're going to be able to sell it to. And it's not too much different than the California gold rush, when people were speculating they could find gold. If there were, very few people were lucky enough to do that, and they were the people that were knowledgeable and worked hard and they speculated. You still have to have some luck. So that's why I call it speculating.
I see. So you've spent your career putting money into what, tiny little exploration mining stocks, hoping to sort of strike it big once out of every 10 times or so, and knowing that the rest are going to fail, right?
Yeah, maybe not fail. I liken small caps, and it doesn't have to be in the natural resource sector. It can be any of the hot sectors of the day. I mean, we see all the headlines daily right now about AI. I think people are speculating in AI. I think that's probably will change the world, but I think, you get the fear of missing out and people investing in anything, and and they're not really investing, they're speculating that someone else will buy the stock tomorrow, next week, or next year at a higher price. So, but in the natural resource sector, I've made a career out of, trying to find the good companies, and I can give you examples without names. Again, there's, I'd like to say I'm always knowledgeable, but sometimes the deals that I'm in, I try to be in 10 to 12 deals spread against different commodities and different country risk. And, if I rank those deals on a scale of 1 to 12, and I put the deal that I think is least likely to work, it's often the deal that works. That's speculating, but they're all decent deals. Does that make sense?
Sure, absolutely. Yeah, it's a classic sort of humble view of the really successful speculators. They know that any one of them could go, 100 to 1, and that their favorite one could go to 0. And that sounds like you've learned that lesson long ago.
Yeah, and most of these companies that I'm investing in aren't right for, again, it's high risk. And so when I say I don't invest, I own dividend paying stocks. I have a fairly significant retirement account. I'm essentially retired now, but so I still invest in companies, and I watch the financial markets, and I see what we're doing to the dollar right now. And so I understand investing, but my career has been in speculating. So, 2 years ago, I financed a company, and these are penny stocks. I often equate them to burning matches. If you hold them long enough, no matter, they tend to burn you. And that's all small cap speculations. It could be cannabis stocks. It could be 99% of the cryptocurrencies. Doesn't mean you can't make money buying the hot new cryptocurrency. But you have to be able to realize that you're speculating, and if you hold it long enough, it probably won't work out. So a lot of the times you're speculating. That's what you talk in your newsletter about some of these meme stocks, and obviously that's not investing. That's people gambling. I mean, that's not even really speculating. That's waiting for the greater fool theory.
Yeah, that's pure gambling, isn't it? Considering that, I mean, talk about burning matches. They're failing companies and dying industries loaded up with debt, just lighting cash on fire quarter after quarter. And these people think they're going to make a fortune by holding on for the long term because they're going to get a short squeeze or something that's going to last forever. I don't quite understand it.
No, but in this market at this point, you've had, as you realize, of all people, and what you're right, you've had a situation that's never happened in history, where they've had interest rates close to 0 for a prolonged period of time, which has forced people into being speculators and less investors. And people don't know any better. There's, I talk to people all the time, and I'm 55 years old. I guess that's old now. Because I talk to, I have a very successful guy that if success is based on how much money you've made, he's very successful. But he asked me the other day, he said, what was it like when the market, crashed? And, how did these resource stocks hold up? He's in the resource stock industry. And I said, when the dot-coms crashed, and there was silence on the phone, and he said, what do you mean the dot-coms? Well, I forgot he was 35 years old. He's talking about the real estate crash. He was like 8 years old during the NASDAQ bubble. But I've seen, and I was younger too. I've seen 3 pretty good overall financial market corrections in 92 when I first got out of college and entered the resource business, natural resource, and learned a lot watching a gentleman by the name Rick Rule, who you and I both know, and was a great person to study in the space when I was young, and got to communicate with him, and same area as him. And anyway, so I've seen it 3 times, where you've had the dot-com NASDAQ crash, the real estate, whatever they want to call it, correction, and also the 92 recession. So what I'm excited about in the natural resource sector is I think we're in for the pendulum swinging the other way here in the financial markets, and some reality coming back to less speculation and more investing, which I think is going to hurt a lot of people in their investment accounts. But what happens out of those bad markets is when things settle down and we move forward, the natural resource sector tends to have their biggest booms where, instead of trying to get 1 in 5 stocks right, almost every stock works in the short term wildly, because it becomes the new hot thing to speculate in copper, to speculate in zinc. Because at the end of the day, when we have the reset, people realize we need more of this stuff, and it's getting harder to find, more expensive, and there's a lot more political risk where you can find this stuff now. So you're going to head into probably one of the best resource markets I've ever seen. And I've seen 3 really good ones after major corrections in the overall financial markets. So I think we're within a couple of years of just seeing things like copper, uranium, you've already seen lithium because of the electrification of things, which is a whole nother topic, whether I believe that's actually going to come to fruition or not. But I think the commodities are going to do really well.
All right. So now I understand why you're a speculator and not primarily an investor. And you clearly have some of the same thoughts that we've talked about on this show before, that we're coming into a time when being a speculator in some of these natural resources is an absolutely wonderful idea. And you mentioned, in a couple or 3 years or whatever, is that how long you think it's going to take for it to become a great opportunity, or it's already a great opportunity now, and that's when you think it's going to start paying off?
Like in most things, I can't tell you the timing of things, Dan. I think I know what's going to happen. I can't tell you exactly when it's going to happen. So like in anything, it's rich or poor, it's good to have cash. You don't want to find yourself in a situation where you're over leveraged and you can be right in the longer term and really get your butt handed to you in the short term. So yeah, my personal belief is that we're getting very close to a problem in the overall financial markets that's much greater than last summer. And I think we're going to see asset valuations, especially in the stock market, come down considerably. I think coming out of that, you're going to have an incredible opportunity where a lot of these speculative natural resource stocks, and even the bigger ones, the Barricks, the Newmonts, the Cameco, uranium companies of the world, will do really, really well. I mean, even those companies will be up 3 or 4-fold. Yeah, we're coming into that time again, because it's always been that way when I've seen financial, so to speak, panics in the overall markets. But yeah, I'm personally buying some things right now, with the idea that I may have to hold them. On paper, I may be down 50%. These are highly illiquid companies that are burning cash, looking for, trying to improve, or looking for an asset, a commodity that they're trying to grow the deposit. So yeah, I'm investing now, but I realize it could be a year from now or 2 years from now by the time they take off. I don't think they're going a lot lower, and I'm not using money I don't have to do that speculation, so I don't have to sell at any given time.
Right. Patience required. We've heard some of this strategy from Rick Rule in past interviews. So we do. Hopefully, the listeners will recognize it again, as I do.
Rick is one of the most serially successful speculators, entrepreneurs in the natural resource space. So, I greatly respect Rick's opinion, and he's been around longer than I have, and obviously done very well. But even in a bad market, and people like Rick do well even when the resource market isn't doing well, because they understand in these speculative things you're betting on people, share structure. And again, if you don't get the timing right, you want to have management and an asset that can make it to the next cycle. So even in the market that we've had for the last 2 years, and some of the other people you've interviewed and I, listen to me in the speculation side of things. That's why I'm talking to you, because you've had a couple people recommend that I might be a good person to talk to. But they've invested in deals, and 2 years ago, I'll give you an example. We put money into a highly speculative lithium play, but it was a good share structure, decent people running the company, and the asset looked like it had promise. It doesn't mean it's going to work out. And when they went out to drill that asset, they got very lucky, that it turned out to be much bigger than anybody thought it could be. And it's gone on to be probably it'll be the largest lithium resource in a deposit in North America. And that's something that, again, these are tiny cap stocks, and that we financed at 15 cents, and it trades at $15 now. And it's probably going much, much higher. So it doesn't take but a few of those to make up for the ones that, go out and try to do something, and it doesn't work out because Mother Nature didn't cooperate, or a country's political structure changed, or the myriad of things that can go wrong.
You have pointed out more than once that it is such a risky space. There are so many risks. I can't help thinking that focusing on that space in the way that you have for 30 years is a really kind of a personal choice. What is it about your personality? Like, are you especially patient, for example?
I don't think I'm especially patient. I think I'm averagely patient. There are people that, again, are much more successful. And, and again, I think a lot just comes as you get older and more experience in that space. But yeah, I focused on that space. I liken it though, and my wife hates when I do this, but it's a form of treasure hunting. I mean, again, I know that it's not always going to work out, but you have to have a personality that when something doesn't work out, it doesn't really upset you and that you worry about it constantly. You move on, and you speculate again on something. And I guess it's the excitement when things do work out, like the company example I gave you. Again, it's when you put a few $100,000 or $500,000 into a deal, and some people are putting 5,000, it just depends on what you're doing. And it should be your risk capital in this space. Again, it's not investing. You're not putting your retirement account in the 100% into the natural resource space. Although there are people who do stuff like that and find themselves wildly lucky. I'm sure somebody who bought AMC at the beginning and sold it at the top, thinks they're pretty smart. But at the end of the day, yeah, you want to invest in, there's so many people that are selling things that aren't necessarily true. And you got to differentiate in this speculative space that, these people are real people and have had success. And then you've got to accept the risk you're taking, and you've got to enjoy the highs and lows of, 1 minute. Well, I had another company that's doing very well, and they had to shut down all their operations yesterday because the province of Quebec in Canada has 162 wildfires right now. So this company was full steam ahead drilling off an asset, and they've had to shut down drilling. So that's kind of a bummer. On paper today, I'm losing money, but I can't control that. And again, there's things far more important than whether my company can be drilling, as when other people are possibly losing their houses. So you got to keep everything in perspective, right? We can talk about the financial markets like you do, but at the end of the day, it's all important until someone tells you the new mole on your skin's cancer, and it all goes away pretty quick, what you were worrying about yesterday. So you just got to take everything with a grain of salt if you're a speculator.
That's a very philosophical view. When losing large sums of money is a possibility, or any sum really, pays to be philosophical, I think.
Yeah. And again, not everybody's cut out to wake up one morning and look at their portfolio and see it's down. When COVID hit, in that first month, I watched a portfolio of resource stocks drop 50 to 60%, which was tens of millions of dollars in a month. It's and some people that's nothing to them, and some people that's a lot. I mean, everybody's different, but you have to be able to stomach the ups and downs if you're going to speculate. You have to, and most people don't really even realize, and normal people that are investing a lot of these things now, whether it be, you've talked about what's her name at the ARK funds. I think that's going to be like some of the .com people that I can't even remember their names anymore that were the hottest players, and I think that all goes poof in the future.
Yeah,
but you know more about that than I do. But I just think there's a lot of people that, because of, I'm sort of off what my subject is, which is natural resources, obviously, but I just think there's not a lot of investing anymore. It's everybody's a fear of missing out, and everyone's been pushed into the stock market. I mean, I had a hard time teaching my daughter about why she's 17 years old. So for 17 years of her life, I couldn't really explain. You think I would? I'm a finance major. I couldn't really explain to her why she wanted to put money in a savings account. Literally until recently, we've actually had some meaningful conversations. She's going to college now, and I've explained to her why she wants to set up her IRA and why she wants to put some, part of her paycheck into a savings account because she can earn 4.2%. I could never have that conversation with her. And you think about all the people that have gone from 50 to 80 in the last 20 years or 50 to 70. And, they've all been forced to be in the stock market. They've all been forced to go in the casino, so to speak. And it's been skewed. So, I'm, fairly negative on the consequences. I don't know what's going to trigger those consequences, but I think, we're starting to see it in the commercial real estate market. I have a good friend here in San Diego that's one of the biggest brokers in the life science business, which is a huge business, a huge speculative stock market here in San Diego. And he said it went from the best in his 30-year career, the best sales and leasing environment he'd ever seen, to the worst he's ever seen in less than 6 months. He's actually retiring because there's no business. So I think that's the start of, I think the interest rates moving up, and I think, the amount of money they've printed, I think we're going to start seeing consequences that it's above my pay grade. I can't tell you exactly what those are going to be, but I think it's going to be bad.
Right. So you're just over 30 years, you've developed a healthy respect for cycles, it sounds like.
Absolutely. And again, I couldn't give anybody personal investment advice because I believe, having a third of your money in speculative investments to make a good return, a third of your money in real estate, and a third of money in other hard assets is probably a good investment strategy. It's worked for me, but doesn't necessarily work for everybody. And, but again, I think I mentioned to you, I'm a big car collector. I'm sort of a car nut. I like history, and I like old cars all the way from the 20s through the, 70s and 80s. And, you see even that market's, it's become ridiculous. People, I used to laugh with Doug Casey, who you and I both know, because he's on record of saying, 12 years ago that the muscle car market was the biggest bubble he'd ever seen. That bubble's grown fourfold since then. And I didn't disagree with him then, but my point is all of these things, because of the easy money, have been pushed to astronomical levels. And I think that easy money is going to start to evaporate, or they're going to print more and more, which is going to be worse.
Yeah, it's an odd juxtaposition, isn't it? Because on the one hand, many people right now are saying, well, the Fed can't keep this up forever, and they're going to have to go back to low interest rates because they're going to break the economy, et cetera, et cetera. Meanwhile, employment numbers and GDP and all these things are surprising to the upside, and the stock market is reflecting that.
Oh, the stock market, yeah. The stock market, again, for all that you and I probably share some of the somewhat similar views on parts of the financial markets, the stock market really isn't off that much at all. And when you look at the fact you've had some You've had a geopolitical event that hasn't happened in a long time with Russia and Ukraine. You've had several quite large banks here in California fail, and one in New York. They were funding a lot of the speculative tech stuff and office stuff. You don't see the consequences. It takes longer to see those consequences, and I don't think we've seen the consequences yet. But maybe you disagree. I don't know. So.
No, I actually do agree on that point. I don't think the shall we call it the unpleasantness in the banking sector is done by any means, because it really hinged on those banks that failed. I don't think we'd be talking about them if interest rates were still zero, because they bought a bunch of expensive securities and they had to write them all down, and they really had to write them down because they had to sell them.
Right.
In the case of Silicon Valley. So, they had to take the loss, not just write it down. So, are they the only people who bought securities that, treasury securities with, near 0% yields that year? I don't think so.
I agree with you 100%. And I think there's other areas that, again, that the increased interest rates are going to start, I think they're tremors now. I think they're going to be much bigger cracks as we move forward. And like you said, that some people believe the Fed's going to reverse course and lower interest rates. Either way, I think the patient's pretty critical at this point, and you're going to bounce back and forth, until you have to have a reckoning, which is bad debt has to go away. Companies that don't make a profit, that have been able to buy shares back, and then by borrowing money cheaply, are going to not be able to do that anymore, and you're going to have a reset. And that's when my space is, again, I'm always in the resource space, and then I've been around long enough that I, managed to do well and year in and year out usually. But about every decade, you have an event in the natural resource space, it becomes like a meme stock space. Everybody wants to be in it. People realize that, copper is really going to be difficult to meet the demand here in the future because the easy deposits have been found. They're going to start realizing that uranium costs $60 a pound to get out of the ground, and it sells for less than that. So we've had underinvestment in the uranium space. They're going to realize that, zinc and other things are in the same boat. And what you end up having after that financial reckoning is a very good natural resource market, because at the end of the day, whether it's the speculative stuff or the bigger companies that funds tend to buy in those spaces, those companies do very well because they're hard assets. It's a finite asset that's getting more expensive to get. And again, I'm sure you talk to people in you can't not read a paper and read about electrification and the Green New Deal and solar and everything else. But it's amazing how many people that are what I would call very environmentally friendly and are all for this, but when I ask them where lithium comes from, they can't answer the question. Or I'd say, how much copper does it take? And where do we get our copper? Or do you realize your Tesla has X number of pounds of rare earths in it? Do you know where rare earths come from? Well, they all come from China. We don't actually make our own. They're all processed in China. And their environmental standards are extremely low. And, so it's always ironic to me that at the end of the day, you need the metals, and they come out of the ground. That's where we get them, If you want to plug your cars here, California is passing, they want to be fully electric by 2000, whatever. I don't remember what it is now, but I don't know where they're going to put all the charging stations, because we don't have a lot of real estate left here in California. And on top of that, the power grid is based on fossil fuels and non-clean energy, and you still have to power your Tesla. That's a whole other conversation that's interesting. Anyway, I'm off on a tangent. Sorry.
No, that's a good tangent. I mean, when people talk about like all of the sort of fashionable ways to consume things like, green energy and even veganism, they're completely out of touch with the reality of how metal and food is produced. Vegetable farmers kill hundreds of thousands of animals. They decimate the landscape of animals. And people are like, oh, we didn't kill a cow. Yay, we ate carrots or whatever. And I'm like, well, yeah, you killed 100 squirrels and 100 moles and 100, whatever else. But sure, you didn't kill a cow. And it's the same thing in copper. It's like, okay, Mr. Environmental, are you okay with a new, Chucky or Escondido mine, one of these massive, massive copper mines in Chile, like every year for the next 10 years? Because it's going to take something like that,
Yeah,
right?
the problem, Dan, is what people don't realize either is because of, and again, I'm all for protecting the environment and doing things responsibly, but it's like well, there's two sides. We don't have a smelter. We don't have a smelter left here in the United States for copper, even though copper is produced all over the world. 60% of it now is produced, smelted, turned into copper in China. You look at uranium. Again, the only real green energy is nuclear energy that has a zero carbon footprint. The problem is that it also has a byproduct that you have to be very careful of. But the Chinese, India, they're building very modern nuclear power plants at this point with new technology, and we are attempting to do that here now with small scale nuclear reactors. But the fact is, most of our nuclear energy structure was built 50 years ago. It's the equivalent to driving a 1957 Chevy down the road in the highway and wondering why when you get in an accident, it's much more dangerous than a new car with airbags. Well, we've stopped. Not only have we stopped in nuclear, we've stopped inventing and improving. We've just stuck with what we've had, not in our backyard. It's the same with mining. We don't mine the rare earths. We don't have the lithium. We don't have the graphite. The lithium ion battery is half graphite. So I love that. And this is probably off the subject that you want to talk about, but there's two types of graphite. There's natural flake, and there's synthetic graphite. And natural flake, only about 8% of a battery, electric car battery, is natural flake. That was 3 years ago, but it hasn't changed that much. Most of it's synthetic, and they make synthetic graphite by hanging sheets of coal and heating it to 2,500 degrees Fahrenheit for a couple of weeks, and they turn it into graphite. Then the Chinese sell it to us for our batteries, and the Japanese to make the batteries so that we can stick them in our electric cars. Well, those furnaces aren't running on nuclear energy; they're running on coal in China, and they're burning it. So it's just that people don't realize that, and now you have the geopolitical risk. You mentioned Chile and the Escondido mine. Chile just nationalized their lithium market about 4 weeks ago, which has created havoc for some of the big lithium producers. And it may change, but again, if you're exploring for lithium, they're making it 100% more socialist. You've seen Peru, which is one of the largest copper producers and ranks high in gold and silver and other metals. They're being led by a government now that, says, not in our backyard. Well, our problem is we get all our metals here in the States from other places because we haven't developed our own assets for a long time. That's going to be a problem down the road.
Yeah. Yeah, it sounds like it. So, Jeff, are you comfortable like giving us a specific name of a company that you're interested in now, or no?
I don't really feel comfortable giving specific recommendations, except your listeners should understand that the natural resources market's going to do very well over the next decade. Prices of these underlying commodities are going up. So if you like uranium, and I don't know what the price of Cameco is right now, but again, if you think uranium, it has to be higher, otherwise the lights are going to go off. People won't mine it. Cameco is going to do very well. So Cameco is a less risky type of speculation. It's an institutional, it's a bigger company, it produces uranium, as opposed to a company that I'm invested in that's got a discovery but is trying to prove it's big enough. And again, I don't, not real comfortable giving recommendations because I don't know who your listeners are, and I don't want people to think this is investing. It's speculating.
Understood. Yeah, it's totally up to you. So, but I guess we've already established that, you're a natural resources focused guy, and, you think this is a good time because over the next several years, with lots of volatile up and downs, it is going to work out well. Or, you're convinced at this point as things stand that the setup is, like you said, either there's a lot more investment and a lot higher prices, or the lights go out, or, we don't have enough copper to do anything that we want to do.
Correct.
So, yeah, got it. Yeah. All right, Jeff. Since we're not going to talk about individual names, maybe you could just, and I realize you've sort of dealt with some of this throughout our conversation, but maybe you could just kind of give us the bullet points, like the 3 or 4 or 5 things that if someone is going to speculate in these stocks, what do you look for? If you could reduce it to that, I don't even know if you can.
Yeah, I think, I have to remember that I'm in this space. So some things I take for granted after 30 years that, but again, a subset of your listeners probably already invest in these types of companies. They probably get promotions from different newsletters and they sound wonderful. This could be the biggest gold mine ever discovered, or this could be the biggest lithium. I see this stuff. I get emails all the time. So, one is to find someone that whether it's a broker or a newsletter writer that's got a track record of a longer period of time and has had some success in the space, and it's worth spending some money subscribing to knowledgeable people. You have a number of newsletter writers in different spaces. It always stuns me that someone's willing to. They think spending $2,000 to get financial advice, whether it's on cryptocurrency or natural resources, is too much money, but they want to invest $80,000 in the space. I'd start by investing the $2,000 in a research who's knowledgeable and who's had a good track record. You got the internet; it's pretty easy to figure out, who's doing what. And I'd invest first in a good advisor, whether it's a broker in a certain speculative space or a newsletter writer. But as far as my space is concerned, there's 3 things that are important to me when I look at a company. And I get 3 companies. I do a lot of private placements. Remember, these companies are burning cash. They need cash to do metallurgical work. They need cash to drill more. They need cash for engineering, acquisitions, if they're trying to grow and add to their portfolio of prospective properties. So I look for 3 things. One is I first look at the management team and see if their track record, if they've had any success in the past. And then I remember that there's 2 types of success. There's a person who actually built a company and sold it to another company, which in my definition is true success. But then there's people in the speculative space that have been around long enough and they've had a number of companies that may eventually have not worked out because of cycles in the commodity space and prices and country risk. But most of their deals have done very well after, they've started them or gotten involved into a bull market. So I look for success, mostly guys who've actually, or women who've actually sold a company. The next most important thing in these companies is to look at the share structure and their cash position. They're always raising money. So I don't want to buy a stock when the company's down to $400,000 in the bank, because I know it's not going to go anywhere because the brokers in this space, Australia, Canada, and some here in the States are waiting to finance this company, and they're going to sell shares to put money back in if they actually like it anyway. So it's share structure and their ability to finance. And then the third thing is the asset. Does the asset merit? There's, 80% of the companies and most of these companies are based in Canada and Australia. 80% of them, are recycling stuff that, my geologists that I employ will look at and say, I stepped on that 32 years ago when I was with Rio Tinto or Placer Dome, or, it hasn't changed in 32 years. They're just putting lipstick on a pig and promoting it because lithium's hot right now. So you really want to find projects that may have the merit to turn into something bigger. So a larger mining company wants to take over that asset and turn it into a producing asset. So really it's people, share structure, and asset. And really people first, share structure, asset third. So that would be my criteria.
I want our listeners to underscore something you said, my geologist that I employ. I bet that helps, doesn't it?
Absolutely.
Be able to employ one's own geologist.
Absolutely. That's what I'm sort of getting at, whether you're fully immersed in the space for years and have lots of people doing stuff for you, or you spend some money on someone, like in your organization that specializes in, I'm not going to go because I read something on Yahoo and it says, this is the next great cannabis company. I'm going to go subscribe to a newsletter of someone I'm just using cannabis as an example because it was a bubble we had that's imploded. But I would want to have somebody that's more knowledgeable than me in the space, go out and look at that sort of thing. And again, in all of these things, I mentioned a friend of mine who passed away and was a newsletter writer for 60 years named Jim Dines. He had one of his, what they call dynisms. And one of them was, always drink upstream from the herd. So, whether you're speculating or, don't follow the crowd, be ahead of the pack. So it was, again, I think when you're doing these things, you know, by the time you're reading about it everywhere online, you've probably missed the boat. You're better off, and the best investment you can make is hiring, whether it's a geologist or a newsletter writer, someone who has a specialty in that space. And that doesn't mean you should follow that person blindly. Often I don't agree with my geologist, right? I think the shear structure and the people will overcome the mediocre asset or they'll add other assets. But I want to have a lot of different opinions. So again, if you're going to play in any space, specifically the natural resource, high risk junior space, getting, good information and spending money, you got to spend some money to make some money. And a lot of people don't do that. They just want to make money and have anybody on the internet tell them what they think they should do. So again, that would be my advice.
All right. Well, it's time for my final question, which is the same for every guest, no matter what the topic, even if it's non-financial, same final question. And you may have answered it already, and that's cool, because I did ask you for, the list that you just gave us. But now, instead of, 3 or 4 things, I'm going to ask you if you could leave our listener with just one idea today, what would that be?
One idea today. I guess my one idea today was, I sit here and read all the financial stuff and have been, successful in my space and a successful investor in real estate. I've developed real estate. I tend to, since this is a financial show, without being too corny, my one piece of advice is, find balance. Don't focus too much. Don't get consumed by, planning for retirement, planning for this, what might happen, how bad it could get. Remember that the most important things are you're not given any guarantee on your time. Enjoy your family, enjoy your health, because eventually we won't have our health, and don't worry so much and have fun. I don't know if that's too corny for you, but that would be my advice.
Not at all. You echo more than one previous guest with that answer. And it's funny because it's usually like the really successful people who I know have put in massive hours. They're saying, hey, there's more to this than putting in all these hours. So I appreciate that. I'm sure the listeners do as well.
I've had several people point out, and we all joke, especially being in the commodity business, what's the most valuable commodity? And, especially younger guys, I'll sit there and think, is it gold? Is it copper? Is it lithium? Is it this? And the most valuable commodity you have is time.
Yeah, I knew it.
Use your time wisely.
Yeah, certainly a finite amount of that. We're all born with peak time.
Yeah,
right?
But I'm not discounting the fact that you should plan your finances and you should, and you should save and make good decisions. But at the end of the day, you want your health and you want, I guess the other piece of advice would be, rich or poor, it's good to have cash. Don't ever over leverage yourself. Don't find yourself in a position where if your timing's wrong, you can be wiped out. Make sure you invest and speculate responsibly.
All right, Jeff. Well, listen, thanks for being here. I really enjoyed talking with you. I'm sure our listeners enjoyed it as well.
Oh, I hope it was something they enjoyed listening to, but thank you for having me.
Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report.
Well, I hope you enjoyed that. Jeff is he's just a super successful investor. You almost couldn't tell by the way he talks about things because he's not like bragging and he's not trying to sell you anything and he's not trying to convince you of anything really. He's just kind of telling you what he's doing and why. And those type of people, they almost seem to fly under the radar, but that's the attitude of all the very best, wealthiest investors that I know personally. They're never trying to convince me of anything, really, which I find very interesting. It's like they have, strong opinions, lightly held. And Jeff certainly has that, right? He said, well, I could be wrong. I could lose money, et cetera, et cetera. But his success speaks for itself. And you heard him refer, when I asked him, what are the things you like to look at? And the first thing out of his mouth was the management team. And then the second thing was, do they have a track record of success? That's a big hint, right? And being able to hire your own geologist is a big hint if you're going to speculate in natural resources. And then before he even talked about that, he said, get a broker, an advisor, a newsletter writer. God bless him for saying that. And, somebody who's really good, who you can trust. So a lot about relationships and people was embedded in just about everything he told us. And if there was one takeaway, that would be my big takeaway from talking with Jeff. Anyway, wow, that was a great conversation for me. I hope it was for you too. That's another interview and another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do us a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. If you have a guest that you want us to interview, let us know. Drop us a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.